Welcome everyone. Today we're going to be discussing price range, dwelling in equilibrium and discounts. Price moves in ranges most of the time. Defining the most significant price range to work with can be influential in mapping out your charts for proper context to your trade setup. When you open up a chart, you see that price always moves in range. It's not all the time that you see price going up or going down. It moves in ranges. When the market is not trending on a particular time frame, knowing how to use the price range comes into play. Now, what is a price range? A price range is the most impulsive price move, either bullish or bearish. It could either be going up or going down. That impulsive move is a price range. It forms a price range. But then, a significant price range is the most impulsive price move that has its buy side and sell side liquidity untaken. So that move, that impulsive move, either up or down, that has the top and bottom, that is the buy side and the sell side liquidity not taken yet, is a significant price range, and that is the price range you want to be working with. What you want to work with for a trade setup is a significant price range with both the buy and sell side left untaken. So now we're going to be seeing what the price range is. Now look at how the market moved from this point here to this point, retraced, moved, retraced, moved, retraced, but then moved. So this huge move here is a significant price range. I want you to know that this move here is a price range. Here is also a price range. Here is a price range. Here also is a price range. This is a price range. So this impulsive swing is a price, forms a price range. Now, what range does it form? From this place to this place is a range. You draw it out. Let me bring out the pen so that I can. So from here to here forms a range. From here to here forms another range. From here to here forms another range. From here to this point here forms another range. But which one is significant? What I mean significant, I mean which one should you use to trade? The one you use to trade is the one that has the buy side and the sell side untaken. But look at this, from this range to this range here, the buy side was left untaken, but the sell side was taken. So you can't use this range again. From this range to this range, what happened? The buy side was taken, but the sell side too was also taken. From this range to this range, you can see the buy side was taken here, and then the sell side was taken here. So you can't use it. So the one we should use is this swing here. Because why? The buy side and the sell side are left untaken. So by significant, I mean which one has the buy side and the sell side untaken. That is the range you should be working with. So I hope we are not confused. Okay. So we can see that market does not move up continually. There are times it moves and then retraces. And then look at how it retraced it and began to range. It ranged there. And then there was an impulsive move here, breaking these highs and these lows. And then it retraced. And then we're expecting it to break out this high, because we can see here that price moved up, then came down, started ranging with a high probability of market breaking this high, what we can see here. For a trend to be confirmed, if it is a bullish trend, we want to see the highs being taken. Let me draw it out. So the market rallies upwards and retraces. Once it rallies to break this high, it forms a trend. So we expect it to retrace and then break this high, retrace, and then break this high like that. For the same for the downtrend. The market rallies downwards. After retracing, we expect it to break the low. Then once it breaks it, as it retraces, we expect it to break the low that was formed, the lower low that was formed like this. So this already forms a trend. This is an uptrend, this is a downtrend. But in real life, market does not move like this all the time. There are times that the market would move, retrace, and then continue to move within this range. So you knowing how to map out a range can give context to your trade. So that you know where you are in this range. Either you are above or below. But also market also moves in ranges. Even as it's trending from this high to this low is a range. So market retraced into this range before moving up. From here to here is also another range. So market retraced into the range before going higher. The same for a bearish trend. Once market forms this swing, it creates a range. So this retracement is a retracement into the most recent formed range. So after retracing into the range, market rallied downwards, breaking this low, forming another range. So we should have an idea of what a range is. A range is just an impulsive price swing. But a significant price range, which is what you should look for in order to trade for, is one that has taken both buy side and sell side. But the buy side and sell side have been left untouched. Because if we look at this, you can't be trading with this range anymore because this buy side has been taken here. It has been taken here. So the range you want to be changing with is this because the buy side and sell side are left untouched. And we know that market seeks buy side and sell sides. So that's very important. Price range is fractal through all time frames. What does that mean? It means you can find price ranges in all time frames. A significant price range in a 5-minute time frame might be a trend continuation on a 15-minute time frame. So therefore, price ranges are used in context with the time frame you are trading in. So now let's say this is a 15-minute time frame and it's trending. So this could serve as a range in a 5 minutes. If you go down to a 5-minute, you will see something like this. Different ranges being formed just on this range. So we are seeing that there are trends that can be found in a higher time frame swing. Just all I'm trying to explain here. So you want to be using price range in context with the time frame you are trading in. So you can't say that, let's say you want to trade in a daily time frame, but then in a 5-minute time frame, it is trending. But in a 1-day time frame, what this whole trend represents is something like this. Let's say you have an upward trend like this, and the market is going like this. It could be that this whole thing that you are seeing here is just something here. So you can't just go to the 5-minute time frame and say, since it's trending, I should be buying. Meanwhile, in a daily time frame, this whole move is still inside a price range. So it's good that you know what time frame you are trading because market can be trending upwards in a 5-minute time frame, but in a daily time frame, market is ranging in this range. So I'm going to be explaining how to use a range to trade in this lecture. And we're going to be seeing how that we can't just buy anywhere or sell anywhere. We have to buy at a particular place in a price range. So because market is moving in a 5-minute time frame and it is trending, doesn't mean that you should buy because this whole move can be this move that we see here, ranging in a daily time frame. So now we can see an example here. This whole move here is the same thing as this move here. Let me show you this move here. So this is a weekly time frame. Then here is a daily time frame. So inside this weekly time frame, we can see smaller ranges. You see from here to here is another range. But then market took the high and the low, the buy side and the sell side, forming another new range. Here is also another range. So market took the buy side. So here again, formed another range. So we can see ranges being formed inside just one range. So you can be trading inside this range. If you want to be trading in a daily time frame, this range is a significant price range for you to trade before this move downwards. Let's say price at this top here. You want to use this range to trade the market. Why? Because the buy side has not been taken and the sell side has not been taken before this down move. So you can use this range to trade in a daily time frame. But in a weekly time frame, this range has not even been formed yet. So the whole message I want us to get from this is that you need to be trading price range with time frames. So what can be a trend can be a range in another time frame because here is just one range. But in a daily time frame, we can see this range forming a trend. It is forming a trend. You can see it forming a trend. So because you say, okay, This now is an uptrend because it moved, consolidated, it expanded, it retraced, broke the high, expanded, retraced. You now say, okay, we are buying. Let's go and buy. So once market retraces, you want to buy. But look at how price moved. Because why? We are in a huge range. We're in a bigger range in the weekly time frame. So it is good that you know where you are in context with the time frame that you are trading. In a price range, the midpoint from the top to bottom is called equilibrium, and this is fair value. Above equilibrium is premium. Below equilibrium is discount. All right. In a price range, you want to be buying at discount, that is cheaper price relative to the price range, and selling at a premium, that is expensive price relative to the price range. Now I explained that we're going to be now. Now I already said I'm going to be explaining how we can be using a price range to trade the market. And I also mentioned that you don't just trade anywhere in the price range. There are particular places you have to place a trade in a price range. So you understanding what a price range is, how to identify it, and how to classify it based on the premium price and discount prices would help refine your trade setup in order to take profitable trades. Now going further, this is the price range I showed before in our previous slide. From the high to the low, it formed a price range. And you can see that the buy side has not been taken, the sell side has not been taken, and price has been trading within this range, inside this range. Price did not break out above, price did not break out above, and price did not break out below, meaning that the buy side and sell side are left untouched, forming a range in which price has been trading for quite a while. All right. Now you can see that from the top to the bottom, the midpoint here is called equilibrium. It is the midpoint from the top of the range to the bottom of the range. Now, above the equilibrium price is where you find the premium. And then below the equilibrium price is where you find discount. You want to be buying below the equilibrium and selling above the equilibrium. This is where you find the best buys, where you find the best sells. Why? Because relative to this range, the price below the equilibrium is cheap and the price above equilibrium is expensive. So you want to buy when price is cheap and sell it when price is expensive. Now, who makes this price cheap and expensive? It is the market makers. They're the ones that deem it to be cheap and those that deem it to be expensive. And we all know that the market makers are the ones that move the market. So we want to be doing what they are doing. They want to buy when it is cheap and sell when it is expensive. So you follow their handwritings in the market. We can see a price move from discount to premium, from premium to discount, from discount to premium, from premium to discount, from discount to premium, from premium to discount, like that. This is how price moves from discount to premium, from premium to discount, from discount to premium, from premium. And look at the equilibrium. Look at how price moved around the equilibrium. Equilibrium serves like a magnet. Another characteristic about the equilibrium is that price tends to consolidate in the equilibrium. Because why? It is fair value. It is neither expensive nor cheap. It is fair. It is a fair price. So price tends to store. So it's one of the characteristics of price being at equilibrium. So the best place to buy is at discount. So when you open up a chart, you want to map out the significant price range, the most significant price range. That is the price range that has the buy side untaken and the sell side untaken. When you map it out, you divide the range into premium and discount by the equilibrium price. So you want to know where you are in the market. Now we are at premium. Not that you can't buy here, but where you will have the highest probability of making profit is when market is at discount. So if you want to be buying here, you have to be buying with a lower risk because while market's already at premium, but if markets should retrace down to discount, it gives you the opportunity to buy at a cheaper price with a high probability of price going in your favor. Because market moves from discount to premium. Market does not move from premium to premium. It moves from discount to premium. You can see it here. From discount to premium, from premium to discount, from discount. It moves like that in a range, price range. So once price moves like this huge move here, we know that this is the handwriting of the market makers because nobody can move the market like this. Once price makes a move like this, we know that the market makers are the ones moving the market. We wait for a retracement into the range. So once price retraces, we want it to retrace into discount so we can buy to continue. Okay, so I'm going to be explaining further. Now, let me show you how to implement the price range for taking trades. Price can appear in two different forms, as we can see here. Price can be moving in a trend like this, from forming higher highs and higher lows, higher high, higher lows, higher high, higher lows, higher high, higher lows. What you want to be doing is once price moves higher, you want it to retrace down into discount for you to buy to continue the trend. You don't want price to go like this and then come down and then buy here, expecting it to go up. Because this point here, because from this range to this range, this area here is premium. You want it to go down into discount that is below the equilibrium before you continue buying. So once it moves high and breaks this high here, you expect it to retrace where? Into discount that is below the equilibrium before you buy. You don't want it to go something like this, then retrace a little bit, and then expecting it to go high. You can as well buy at this point, but here is a low probability for making profits. But once it gets below the equilibrium, it provides a high probability trade for you to make profits as market rallies above. Another form you can see price is this, where price makes a range, retraces, and then continues to trade in that range. You can say that price left this buy side and sell side untaken. So this is forming a range where price has been trading. So once you map out this range, you get your premium, which is above the equilibrium, and then the discount, which is below. All what you want to be doing is to be buying at the discount here, buying at a discount, buying at a discount, buying at a discount, and then selling at the premium. So when I say buying at a discount and selling at a premium, I don't mean you enter a trade here and you buy, and then you wait for it to go above the equilibrium to a premium so that you sell. No, I don't just mean that. I mean, when you buy at a discount, you want to come out at a premium because, like I said before, if you buy entering the market, to come out of the market, you sell. So if you are buying here, you want to come out of the market by selling at a premium. So this market might be an uptrend, but because it formed this range, you don't want to enter the market by selling here, hoping the market will go down. Let me take all these drawings so that we don't get confused. So let's say this is an uptrend, because we are not just using this blindly, like, okay, because market is a premium, let's sell. Market is discount, let's buy. No, we're using it with context. So you finding where price is within a range helps refine your trade setup. So now I explain it again. Let's say this is a price trend. Let me draw it better. This is a price and it's trending upwards. This is a bullish trend. Because mind you, this whole move here could be a retracement in a higher time frame. So let's say we can say this whole move, this down move here could be what this is in a lower time frame. If this is a daily time frame, this might be just a look like in a 4-hour time frame. I don't know if you understand, because price is fractal. So this move here could just be a swing of how it will look in a daily time frame. But how it will look on a 4-hour time frame, you will see this noise. This noise. So this can just be a retracement. So you use it with context. You don't just trade it anyhow. So when you see a market like this forming a range, let's assume it's a bullish trend, you want to wait for market to go down below equilibrium at discount for you to buy. And then you want to sell here at premium, or you could sell here. So you expect price to continue trending. But most times it doesn't happen like this. So what you want to do is you could take partials at the premium. Let's say you buy here at discount. You could take partials here. Let's say you entered with 30,000 units. You could take out 10,000 units here, expecting that the market will continue to rally before you take out the remaining of your trade. So all this is just to give context. So imagine you buy here and then price moves and then you take part of your trade. Then price retraces to take you out. What happens? You want to enter again because price is at discount to buy, and then you take out partial of your trades. Let's say market was able to go above equilibrium, above a high, maybe a high formed here, maybe you have something like this. Let's say it moved like this, retraced, then moved like this again before retracing. then move like this. So this is a high in a what? Premium. So you want to take out your trade in a premium. So we're going to be discussing more of how to use this in a discount market. The next lecture, we'll talk about how we use it in a premium market. So I just hope you understood everything I said. So you want to be buying in a discount and selling in a premium. But then again, we have to also refine where are we going to be buying in a discount and where are we going to be selling in a premium. Just because market is in a discount does not mean you should just buy. Where exactly? So I'm going to be explaining that to us. Now, I will give you an example. Look at how market moved from here. It consolidated and then expanded, consolidated and then expanded. You can remember our previous lecture. After consolidation, what happens? An expansion. Look at how market consolidated. Here was a reversal because why it took this liquidity. People who enter the market will think that market wants to start going down because look at how it was going. And it came down, took out the liquidity before rallying, consolidated and then rallied. So now this is an uptrend. Market is bullish. But look at this retracement here. This is what we're going to be studying. This retracement here formed the range prior to this move here. So what to imagine that this move hasn't been formed. So this because this is hindsight. So prior to this move here, we're going to study this range because this is a price range that has been formed as market was rallying. So let's see how we're going to use it. So now this is the range here. I've mapped it out with some annotations. So this is the range from high to low. So why is it a significant range? Because the buy side has not been taken yet. I say period to this range, and then the sell side has not been taken yet. So how can you now use this range to trade? What do? You map out the buy side and the sell side, and then you divide it to form the premium and the discount. So since it's a bullish trend, you want to be buying at the discount and selling at a premium. So if you see price at a discount, is when you want to be buying. After this range has been formed, knowing that on a higher time frame, this is a retracement, and we expect that price will continue going higher because price is bullish. How can we now use this range to form a trade setup? Now, look at what happened here. Price began to consolidate. And I told you, after consolidation, what happens? Expansion. You can see how price expanded, breaking structure to the upside, telling you that price is bullish. At this point, you can look at this point here. The only significant price move was here. Now, once price breaks structure, we wait for a retracement. Like I explained in our previous lecture, after consolidation, once price breaks structure to the upside, we want to see price go down into what? Equilibrium. So from this low to this high, when you draw your fib here, with this point here, this green box that I drew here, is the discount, and then above is premium. Where do you want to buy? You want to buy at discount. But then again, where in the discount do you want to buy? It is where you now combine it with the reference point and the framework of which I gave you in our previous lecture. What can we see here? This is what? An order block. The down close candle before an up move. Consecutive down close candle. This took down close candle there, formed an order block. Another thing that increased the probability is that this other block took this lows. So there's no need for price to come back down and take the low again. So liquidity has already been grabbed here. So we don't want to see price coming down again to take this low. Because after taking out these lows, it broke structure here. So we want to see that this order block hold price above this low here. So it's a high probability to be buying here and putting your stop at this point here. This point here is what? In the discount from this range to this range, finding support in this order block here. And all this is happening where? In the discount of this range from this high to this low. So I hope you understand. Here is the equilibrium, here is premium, and here is discount. You want to be buying in discount and selling in premium. Another way to say it is that you want to be entering the market with a buy order when market is in discount and coming out of the market with a sell order when market is in a premium. Buy low, sell high. Buy when it is cheap, sell when it is expensive. So we can see here, after price formed a range, it broke out of this range to the upside, telling you that price wants to go higher. But price is still at a premium. Look at it from here. This whole range here is a premium. But then again, you want to refine the trade setup. What do you want to do? You don't just buy anywhere. you can see that the price formed the range from this low to this high, forming another range inside this range. So a range is from inside this range. But why are you now buying? Two reasons, or three rather. This market is bullish. On a weekly time frame, we saw earlier that the market is bullish, but this here is only a retracement. Another reason, market is at premium from this high to this low. Sorry, market is at discount from this high to this low. Then another reason is that market broke structure to the upside after taking liquidity, because it took liquidity. You don't expect price to break this low and then break this high and then come back down and break it. No, no, no. There's high probability that after market takes out liquidity at this side, the sell side liquidity, and then break structure above, you want to see market retrace into the range which has been formed to continue. So we can see context here. We don't just buy anywhere or sell anywhere. We buy and sell at a particular place with context. So now we're not just buying at the discount of this range here that we can see. We are pairing it with an order block which was formed after this range, this consolidation was broken by the swing. So we should go back to our previous lecture where I explained that after consolidation, what happens? Expansion. So we can see here that this actually formed a reversal because market was consolidating and then it broke structure to the downside. Immediately, this is an expansion downwards and then expanded upwards, as you can see here, to break structure. So what happens? We wait for a retracement. Now, before we wait for a retracement, after an impulsive move, because this impulsive move is telling us that market wants to go higher. Nobody can move the market like this. 1, 2, 3, 4, 5. And mind, this is a daily time frame. Nobody can just move the market from here to this point here. No, look at it from 1, this is a gold market. From 1, 2, 3, 4, 5 candles going up and then it broke structures. So we can expect that price is bullish. Price wants to go higher. Now, what do? You don't chase price. You don't now buy here, hoping that price continues going up. No, 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 no. Because here is a premium according to this range. You wait for price to retrace down into a discount. But when do you wait? You wait for price to form 4 candles. Now, let me explain. Now, we can see here, price, this is the first candle was formed. This is 1. This is 1. This is 2, 3, 4. So it has formed 4 candles downwards. Do we understand? This is 1 candle, this is 2 candles, this is 3 candles, this is 4 candles. So once it formed these 4 candles downwards, you want to draw your fib from this low to this high to get your equilibrium. This is the equilibrium. And then you want price, this is the equilibrium. This box here represents the equilibrium. So here is the discount. Here is the premium. So you want price to go down below equilibrium for you to buy. Let me show you another example again before you draw the fib. This is just to show you an example. Look at how price moves. This is 1, this is 2, 3, 4. Now, once it forms this 4 consecutive candle like this swing here, you draw your fib from this low to this high, expecting price to go down into discount before you buy. But don't worry, I'm going to be showing you how to draw your fib. Now, after breaking this structure, you see how price retraces down to its order block into discount of this range from this low to this high, and then into the discount of this range from this high to this low, finding support in the order block. Price rallied. Now, price is at what? Premium. This is premium. But then price did not just rally into premium because I explained before, you don't just buy anywhere in the discount. There's a place to buy in the discount. Also, you don't just sell anywhere in the premium. There's a place to sell at premium. Now look at this. Look at how price moved into what we call fair value. So price moved from the order block, rallied into what we call fair value. Now I'm going to be explaining fair value I think in the next lecture, next 2 lectures to come. I'm going to explain what fair value is. Now, if you look at this up close candle, look at this down close candle. There was no buying. There was only selling. My black candles represent the selling candles. The down close candle, the black candle. So from this up close candle to this up close candle here, this high here to this low of this up close candle, there was only selling. So market wants to go back to close up the sales by buying. So it formed a fair value. This is like a gap. But you can see here that price actually traded up to close part of this fair value and left this part open. So we see here that price rallied and then closed the fair value here. But after rallying, price retraced down into discount from this high to this low. This is the equilibrium. Price retraced down into the discount of this range. After retracing, we can see that another newly formed range was formed from this low to this high. So once it retraces, we want it to retrace into the discount of this smaller range that's inside this whole range. So you draw your field from here to here. As it retraces down into the discount of this range, you want to be buying, but not just buying anyway. You want to be buying at a particular place. You are combining it with what? The reference point and framework, of which I explained in our previous lecture. So here, what can we see? We can see fair value gap. From the low of this candle to the high of this up close candle, you can see a fair value gap. And we can see another fair value gap here. You can see it from this high of this candle to the low of this candle. But let me enlarge it so we can see better. Look at this one here. You can see a fair value gap here. But this fair value gap, where is it? Is at the equilibrium. So it's not a best price. You want to be buying at discount. So you want it to come down. So where can you find a fair value gap that is at discount? Here. This is one here. This is one here. But what makes this significant is because it is hitting this candle, and this candle here is a mitigation block. And now, don't worry, I know I'll be talking about fair value gap, fair value, order block, breakers, mitigation block. All these things will be explained next month. But just follow me. I will give a proper lecture specifically for these terms that I'm explaining. But I'm only just introducing it here so that we can see it and be able to identify it. But if you cannot, you don't worry. Just make sure that you understand the significance of these terms of which I'm mentioning. So we can see the market traded down and then traded up. So there was a sell side and buy side. So this place is balanced. But from here to here was only buying that was occurring. So market tends to go back to close that inefficiency with a sell. So here now is now balanced. But another way to refine it is using the three candles we can see here. So this candle here, this candle here, there was only buying occurring here. From this candle to this candle was only buying occurring here, forming a gap. So there's a gap that was forming. This is the fair value gap. So you don't just sell anywhere in the discount. You pair it up with the reference point of which I gave you in the element of a trade setup. So look at how price retraces down into the fair value gap, and not just any other fair value gap, a fair value gap that is in the discount of this range. And this whole price move is at a discount relative to this whole market range that we can explain. So market did what? Rallied upward into what? A premium. Now, market retrace, you don't want to be buying here because market is in a premium. Although we can see market rallying here. Instead, you want to be taking partials as price continues to rally from the trade you've taken here. So I hope you understand. And what do you think you have here? Buy side liquidity, because there are traders who might have sold and placed their stops here. So they will think that price is going down, going down, going down, and their stops will be placed here. This is just to deceive dumb money, deceive those people who don't understand how price is moving. This will appear to be that price is bearish. But once market makers come in, you can see the handwriting here after they break structure, retrace, break structure. So once market keeps breaking structure in the upside while preserving structure below, it is telling that market is bullish, because you can see a market broke structure here and then this low was preserved, broke structure to the upside, this low was preserved, broke up to the upside, this low was preserved. So it's clear that market wants to go higher. So these are the handwritings of the market makers. Because why does it want to go higher? It want to seek liquidity above the market. This liquidity is what enables market makers to distribute their trades. Now, don't worry, I'll explain distribution and accumulation in the video where I'll be explaining fair value. So don't worry, fair value may be something that's still confusing, but this is just an introduction. I want you all to be consistent in learning, please. Many of the things that will be happening to you is that some of these videos are videos you will come back to learn again after watching subsequent videos I'm going to be releasing. So it's you combine knowledge to get a whole of how the market operates. So let's go into the chart so I could explain more and also illustrate how you could use and set up your Fibonacci. All right, so this is the dollar index. We can see that dollar index formed a range. What is the most significant range that we can see here? This high to this low. Because why? The buy side hasn't been taken, and then the sell side hasn't been taken. So price has been trading inside this range. This is a 3-month time frame. Price has been trading inside this range. So what do you want to do? You want to find your premium and your discount in order to give context to your trades. So you draw your fib from this high to this low. So let me show you what a fib looks like. So in your trading view account, you should come here. Let me just take this out. If you come here, you see a tool, we call it fib retracement. So you click on, you want to also style so it appears here in your favorites. So once you click it, there are certain settings you have to do, but I'm going to show you how to do it. So once you click on it, you go to settings, you'll see many of these boxes here. So you want to unclick them, you want to take them away. So that's what I did here. So you can see this box here represents the lines you want to see here. So if I click this line here, you can see it disappeared, it appeared. You can see here, disappeared. So this is what we want to use for today. So this is the setup. You can change the number. So this is 0 now. Let me say this is 75. Let me click on it. You can see 75% here. If I make it 80, if you go higher, see it here, higher 80%. So this is like 100. So this is 0, 50%, 80%, 100%. 75% is the midpoint from 50% and 100%. So if I put 75% here, see it here, it is a midpoint. So you can find equilibrium inside the premium. You can also find equilibrium inside the discount. So even if price forms discount here and premium here, you can also further divide the premium into a discount and a premium. So that's why you can see these lines here. But for now, I'm just going to talk about the premium and discount with just the equilibrium being at the middle, so we don't get confused. So I'm going to take out these lines here that you can see. So we can see here that from here, this high to this low, we formed a discount. And now notice how price moved around the equilibrium. Look at it. Price tends to consolidate at equilibrium. This is fair value. This is fair price. Neither expensive nor cheap. All right. Price made a move here. Price rallied. Now, once we see price rallying like this, because this is a 3-month time frame, we're expecting that market makers are coming into the market. They want to take price bullish because you and I, as retail traders, cannot make price move like this. So once price moves like this, we want to wait for a retracement. So look at it now. Like I explained before you wait for a retracement, you want to count 4 candles. So this is 1, 2, 3, 4. So once you see 4 candles like this being printed, you draw your fib. So this is our fib from the low to the high. Let me make it thick so that we can see better. So we can see that here forms, this is the equilibrium. So you want to be buying below. You want to buy here. So this is a 3-month candle. It means that one candle represents 3 months. So once price forms this swing here, you would expect, because I told you that what forms a price swing is 3 candles. The candle in the middle is, if it is a bullish swing, the candle in the middle has to be lower than the candle at both sides, left and right. So here has formed a swing. So this candle has formed a swing. So you expect that the next candle to be printed will be a bullish candle. So these 3 months, so this is January. So 3 months, January, February, March, you expect April, May, June to be a bullish month. So look at how you combine the whole thing. Now, why do you want it to be bullish? Because we are at a discount from this range, from here to here. And then inside this smaller range, inside this smaller range that has been formed, this impulsive move, we are also in a what? Discount. Now, not just anyhow discount. What do we see here? This black candle, the down close candle before an up move is what? Another block. So I'll draw a line here. This is another block. Here is a bullish order block. And then price did what? Found support. Now, what else can we also see? Fair value gap. This is a fair value gap because it is formed by 3 candles. The high of this up close candle and the low of this up close candle. We can see here, it formed a fair value gap. Yes. So we can say I will combine different elements to form a trade setup. So if you can see these 3 candle form, you expect that the next month will be bullish. So you can swing trade these 3 months, expecting that this high will be taken. But then we can see that this high was not taken, price still retraced. But as it retraced, where did it go to? It still went back to discount before rallying and then finding support in this fair value gap. And look at how price found support in this all of fair value. And look at the bodies. The bodies respected, the bodies did not close outside the fair value gap. Let me show you clearly. See how the body of these 2 candles respected this fair value gap. How we can see it, telling you that price wants to go higher. And what happened? Price rallied. You can see it here. Let me expand. Price rallied upwards. Rallying where? To discount. Let me take out this fib. Let me show also. Sorry. Price rallied to what? Premium. Now let me draw the fib again so I can see it better. So from here, this high, this low to this high. To this high, market retreats down into what? Discount. This blue line is the equilibrium, and below the equilibrium is discount. Now, this second move was so significant. Why? Because it took a low. Now, once price takes a low in a discount, you expect it to rally because taking out liquidity serves as a reversal for price to rally. Because you don't expect that price takes this low, then breaks this high, then take the low. There's no need for it to come back low again. Now, let me show you something. See how price took. Let me take out this liquidity. Took out liquidity and then rallied. So this move here is staying in the hand of the market makers. Then price retraced, rallied, then retraced again. Now, this low was preserved because there's no need for market to take this low again. That's already taking liquidity. What he wants to do is to rally to take buy side. You can see this buy side was taken, this buy side was taken. So market taking this low is very significant because why? This is not the low that took the liquidity. This is the low that took the liquidity. So this low should be preserved. Now, this move here is very significant. Why? Because this low did not break this high. This low took out liquidity. So there's no need for this low to be taken again. Because why? It has taken out liquidity. Market shouldn't come back down to take this liquidity again. But they can take this low here because why? This low has not broken this high. And this low is where it is in a fair value gap, an order block, and in a discount. So once price takes low at the discount, you expect price to move higher into a premium. Once price takes high in a premium, you expect price to go lower into a discount. So buy stops and sell stops at a discount and a premium serve as liquidity for market makers to move price from discount to premium, from premium to discount. So I just hope that is not really confusing. So I'll go again. You can see here how price took liquidity from of this low. So price took out liquidity. It doesn't mean that this is a break of struggle, so let price retrace and then start going down. No, it took out liquidity where at a discount. So you're expecting that price wants to rally into a premium. And let me give a very good example here again, as I can see here. If you can see how price rallied. After rallying, price retraced. So you want to draw your fib from here to here. So let's take out the fib from here. Where do you expect price to start retracing? After forming 4 candles. See the 4 candles here. You have 1. This is let me take out the fib first. This is the highest candle. This is 1, 2, 3, 4. So once it starts forming the 4th candle, you want to draw your fib. You don't want to pursue this run. There's no need. Expect price to come back down into what? A discount. Now it has also formed the range. So you want to enter at a discount inside this range. So I'm going to draw my fib from this low to this high. What can we see here? That price is at what? Discounts in this range. And not just the discount of this range, but also discount in the overall range, in this parent price range. Price is also at, because this line here is this is the equilibrium. So anything below the equilibrium is discount. So price is at discount from this high to this low, and discount from this high to this low. So look at price. But price is not just anywhere in discount. Price is at a fair value. What is this? Fair value gap. So I will just pull it out here. This is another fair value gap. We can't just use this fair value gap because this fair value gap is like at the equilibrium. We want to buy at the discount. Equilibrium is not discount. Below equilibrium is what we call discount, and it's a discount we want to be buying. So look at it here. So this is discount, but we can as well use this fair value gap. But price doesn't usually come down deep into the discount, because if price start coming deep down to the discount, the probability of price going back upwards is low. You want to be buying, you want to be entering the market when the price is in a rush to go to a particular point. If price start going back down, it will take a lot for price to go higher. So you want to get the best price, which is at discount and not too deep, but at a fair price. Another thing that makes this fair value gap significant is this candle here. This is what we call a breaker. Why is it a breaker? It is the last up candle before taking out this low. So market rallied upwards and then retraced to take out this low, reversed, broke structure. So once it broke structure here, it formed what? A breaker. So this candle here is what we call an ICT breaker. It is called a breaker block. From the high of the candle to the open, this space here is called a breaker. So look at our price. I know. I've been mentioning a lot of things, but don't worry, I'm going to explain it. Mitigation block, breaker block, order block, fair value gap, liquidity run, all these things. I am just introducing it here. So I'll come again. What is a breaker block? This is the last up close candle that formed before this low was taken. So look at this low was taken. So it's something like this. Let me just draw it out quickly. Something like this. When it all came down. Okay. So this point here, this is the breaker block. We're expecting that price bounce before rallying. For a downtrend, it will be the last down close candle before taking the high. So let's say market rallied, it came down, and then rallied again. So this is the last down close candle that was printed before breaking this high. So once it breaks this low, you're expecting it to come back down to the breaker block before rallying down. So it's this structure here that forms the breaker. But whilst for a mitigation block, it's something like this. When price moves up, comes down, moves up, comes down. It doesn't have to take this low. If it comes back down to this low here, it forms a mitigation block. So it's just like the normal support and resistance that you may be aware of support, but no, we don't call it support and resistance. We give it context. So I'm going to be explaining more what the mitigation block and breaker block is, giving it context and what makes it significant, explaining why it makes price moves and how to identify it. All right, so don't get confused. So you see that after price formed this up close candle here, it rallied downwards and it took this low. After taking this low, it took the high that was formed here. So if price is returning back down, it should find support in this down close candle here. So we are combining a breaker block and a fair value gap. in a discount of this range and also in a discount of this parent range to give context that price should rally. Now, another thing again we can add to it, because this candles here represents 3-month time frame, because one candle here means 3 months. So once price dips into this point here, we expect to find support in this reference points for a rally. We can further refine the straight setup by allowing the market to form a swing. Like I explained before, what is a bullish swing is when the middle candle is lower than both candles. So we wait to see this structure formed. This here is lower than this candle by the left, and then lower than the candle by the right has formed the swing. So we expect that the next candle to be formed should be bullish. So this is a 3-month candle. So this is what? April, May, June. So the next candle should be July. So this candle here for the next 3 months, July, August, September, we want to see a buy into what? Premium. So we can see how market moved into premium. But let's look at this month here. This is what? July, August, September. So let's go down to a smaller time frame to look at it. So we'll go down to the weekly time frame. So we can see here that this is July. Look at this place. Here, see it here. This line here, 2nd of July, ending September, July, August, September, 24th of September. So this is where July started. So this is that month. Let me go back again. So this candle we can see here, let me point it out. This candle we can see here is July, August, September. So because we've built context here, expecting price to rally from this point after forming a swing, a bullish swing. We want to see the next candle, which represents the next 3 months to be bullish. So let's go back to the weekly time frame. So we can see here that this is what? July, August, September. Then now, look at this huge rally. Remember, I explained for after consolidation, expansion, consolidation, expansion. We can then couple it with other things. What was formed here? A bullish order block. So I use this candle here because it defines it properly. This formed a high, retraced, and a rallied, breaking structure. So this here is a bullish order block, the last down candle before an open. So market rallied and then retraced back into this bullish order block, finding support before rallying. And then we know that we are building context that because price went down into this breakout, rallied. So we can see that after bringing that into a smaller time frame, we're able to refine it further again by using this bullish weekly order block. Look at how price found support and then it rallied. Rallied where? Into premium. Premium of where? The parent range. Look at it here. This range. This blue. Because now it is in a smaller time frame, so it's a bit messy. You can see from this high to this low, this is the equilibrium. So this is premium. So look at how price rallied, not just into any place in the premium. It rallied into fair value gap in the premium. This is fair value. See how price traded only in the downside from the low of this candle to the high of this candle. Price only traded here. There was no any trading here. So price returned back. So this is where you want to take in profit. You want to be buying in the discount and selling in a premium. Entering the trade with a buy order in a discount and coming out of the trade with a sell order at a premium. See how price move. You don't wait for the whole move because price has only got into a premium. This whole move here is how many pips? Let's say price move from here. This is like 2,900 pips. And then for how long? Let's say you start from August 13th to, no, 23rd July to 13th of August. That's how many weeks? That's about 3 weeks. So that's a swing trade here. If you hold this trade for 3 weeks, you'll be getting over 2,000 pips. So, all right, I hope I've been able to explain this properly. If you have questions, please ask us in the comment section. I wish you all good luck and good trading.